It's just a clear tell where US bond yields are rising and the US dollar is falling, because in most cases, higher US bond yields will normally see the US dollar rise as markets look to take advantage of the yield advantage. But in this case, with the US dollar falling as bond yields rise, it's a sign that maybe markets are reducing their exposure to US assets. And again, that's that sell America trade that you've been talking a lot about.
This is Converge,
a podcast from Canberra.
Come with us as we shape the future of finance.
Hello and welcome back to the Converge Market Update. It's the 21st of May, and in today's episode we've got Stephen Dooley, our Head of Market Insights here at Converge, joining us once again from Australia, and he's going to give us a rundown of the key themes that have been shaping financial markets over the past couple of weeks. So obviously we'll be going to be touching on the global trade developments, but also US fiscal concerns and how FX markets have been reacting to all of this. Steve, it's great to have you back on. Obviously, the big story over the last fortnight has been the US-China trade deal. What's the key takeaways and the market reactions that we've seen?
Yeah, thanks for having me on, George. Clearly, initially over the last 2 weeks, that trade deal between the US and China was the major story. Markets have been on edge, worried about the relationship between US and China. But after a meeting in Switzerland, the US Treasury Secretary Scott Bessent came out and said that there'd been a de-escalation in trade tariffs, in trade tensions that saw both the US and China slash tariffs for a 90-day period. So it's only a short-term deal, but markets saw it as a huge step forward that at least the US and China are talking and they're trying to be constructive. So in short, the US agreed to cut tariffs from 145% down to 30%, while China said they'll reduce their tariffs from 125% to 10% for the next 90 days. So US President Donald Trump, of course, put a very positive spin on this deal, said the agreement had achieved a total reset with China, and US stock markets absolutely surged. The Dow Jones was up 2.8%, the S&P 500 up 3.3%, and the NASDAQ jumped 4.4%. So really big reaction in markets, and they've pretty much managed to hang on to those gains.
Yeah, definitely a big sigh of relief from investors. If you think back to if someone had told you that we're going to still have these kind of tariffs on, you wouldn't have expected the market to react so positively. But the fact that it has been a de-escalation is quite telling. And in fact, the last time we've seen the S&P 500 erase a 15% year-to-date decline in under 6 weeks was back in 1982. So, it really emphasizes how sensitive markets are to this evolving trade war situation. So what do you think's next on this whole trade front?
I really think now that the worst of those headline grabbing tariff impacts are behind us now. Think about how markets were really driven by tariffs, really, since probably the middle of December. It's been nearly 6 months that markets have been absolutely focused on tariffs. I think a lot of the participants have seen the reaction of markets. We saw how markets reacted in early April. I think that the participants are probably more keen to start making deals now. So I think we're probably going to get a series of good news stories about US deal making. We've seen that for that US-UK trade deal, for example. So I think in terms of around sentiment, markets are probably going to see the worst of the tariff story behind us for now. I think we'll see good news stories that maybe the market won't react as strongly to. But I think the economic impact is still very, very real, particularly in the impact of higher prices for US consumers. And looking at the US corporate first quarter earnings season, we've heard more and more stories around corporates looking to raise prices as a result of tariffs. So I think we're probably going to move from the headline phase on tariffs to maybe the real world phase of tariffs.
Yeah, I totally agree. And we've still got that big hit to confidence as well, both on consumers and businesses. And that's going to transfer into what we're seeing in the real economy. Like you say, we're still in this period of prolonged uncertainty that's going to make that confidence hit even worse. But like you said, I think the worst of the headline grabbing tariff impact are behind us for the time being. But still, the focus is still firmly on the US, like you said, and we've still got we've even had the renewed concerns around fiscal stability recently as well, haven't we?
Yeah, I mean, the US has just been the total focus in financial markets over the last 6 to 9 months, and it doesn't seem like that's going to change anytime soon. Probably the big story was at the start of this week with credit rating agencies Moody's downgrading US government debt from the highest level, AA1, down to the second highest, AA2. It wasn't a complete surprise. Moody's had already put the US government debt on credit watch. And of course, we'd already seen the S&P rating agency famously downgrade US debt back in 2011. That really sparked the end of a big move lower in the US dollar and saw the US dollar stage a comeback. And of course, Fitch, the third major credit rating agency, cut the US's rating in 2023. So it wasn't a complete surprise to markets, but it just builds this case of this other story that's been driving along markets away from the trade story, but this uh, declining confidence in the US economy and the US fiscal situation, and that downgrade from Moody's just really brought that story back front and center.
Yeah, totally. I think as well, like we've been speaking about, that typically as a result of what we've seen a surge in bond yields, haven't we? And typically that would normally support the dollar, but because of these whole debt concerns and the undermining of confidence, it's really keeping the dollar a bit vulnerable to this. So that this downgrade reinforces that long-term worry around US fiscal stability is, like you said, eroding that confidence in US policy making and really accelerating this diversification away from US assets. And the US budget as well, that's been in the headlines too over the last few days. What can you tell us?
Yes, so that's again just driving this story, this concern about the US fiscal situation, just driving this story along. Um, of course, US President Donald Trump's trying to push forward his budget, but um, it's been deadlocked really with Republican lawmakers pushing back on a couple of key points. First of all, around state and local government tax deductions, potential cuts to Social Security. Probably most importantly is that this budget doesn't really look to address the large and concerning to financial markets, the large budget deficit around 6% of GDP. And so the fact that we're not seeing any major structural changes in the budget, the fact that we're seeing some tensions in the negotiations, um, continues to make markets concerned about the outlook for the US. And like you were saying earlier about bond yields, it's just a clear tell where US bond yields are rising and the US dollar is falling, because in most cases, higher US bond yields will normally see the US dollar rise as markets look to take advantage of the yield advantage. But in this case, with the US dollar falling as bond yields rise, it's a sign that maybe markets are reducing their exposure to US assets. And again, That's that sell America trade that you've been talking a lot about.
Yeah, yeah, exactly. So I think, I mean, despite all of this fear around and the sell America trade, we have actually seen, haven't we, the over the last few weeks, this rebound in the US dollar from the 3-year lows in the index that we saw, and that was been helped by the de-escalation in trade tensions. But do you think that's got legs? I mean, after the last few weeks of recovery, it seems to have slowed down from the highs that we've seen, and this week has been quite telling. What do you think's next for the US dollar?
Yeah, so I mean, so far this year, the US dollar's been in a clear downtrend. We've been under pressure in the US dollar for really since the start of January. We're down 10% from the down 10% from the highs that we saw in January. So for now, the US dollar remains in a pretty clear downtrend. We did see, like you say, that rebound on that de-escalation of trade tensions, but since then the US dollar has really resumed its downtrend, and particularly this week after that downgrade from Moody's, the US dollar's been down for 3 out of the first 3 days so far this week, and it's now down about 2% from the highs that we saw just last week after that trade de-escalation. So the US dollar does look like it's back in that selling mode at the moment, and it really just looks like the US dollar has the risk of continuing to drift lower in line with what we've seen for most of 2025.
Yeah, yeah, I agree. I think the longer term risks still remain. There's broader structural challenges, and also that whole de-dollarization narrative that's kind of eroding this long term confidence in the dollar, despite the short term relief that it's experienced over the last few weeks, up until this week, that is. So in other markets, obviously, with the dollar rebound losing steam, the Moody's credit downgrade that we've seen, have we seen safe havens outperforming?
That's exactly the theme, and again, that just tells us where the money's going. It's leaving the US, and where are investors moving to into those safe haven markets. So, a couple of the best performing currencies out of the G10, the Japanese yen. And the Swiss franc. So the other two major safe haven markets. So particularly after that Moody's downgrade initially, both of those currencies in particular outperformed. We've also seen quite a strong performance in the European currencies. We've seen the Norwegian krone in particular outperform, and we've seen some of the other Scandinavian currencies stronger, and the euro as well has also been stronger also. So again, really just clearly tells us that picture about where money's going as it exits the US. And I think the British pound hasn't performed quite as strongly as some of those other peers, but it's had a pretty interesting week as well, hasn't it, George?
Yeah, yeah, exactly. I was going to expand on that point with where the money's going. I think the pound's capitalised on the weaker dollar, um, as you said, and it's the major driver of the trend in cable at the moment. But we did see a 3-year high touch very briefly this morning. Again, I think that was mainly as well to do with the knee-jerk reaction to the hotter than expected UK inflation data, which caused some paring back of Bank of England easing bets for this year. But we have seen the sterling dollar exchange rate fall back from those 3-year highs quite sharply. But on that monetary policy front, Steve, we've had some big news from Australia this week, haven't we?
Yeah, look, thanks for indulging me and allowing me to speak about the Australian dollar. But I think it's a bigger story for what it tells because, of course, Australia was really the holdout when it
Mm.
came to cutting interest rates. Most other central banks, most other economies felt like they had managed to tame the inflation dragon. In Australia, we were still on, clearly on alert for price pressures. Everything we'd heard from the central bank is they were still concerned about a breakout higher of price pressures. And while most other central banks had cut rates, a number of occasions up until this week, the RBA, the Reserve Bank of Australia, had only cut rates once. So it was clearly a holdout compared to the rest of the world. Seems like that really changed, not just because they cut rates by 25 basis points to 3.85, but because their statement really moved away from saying we're worried about upward pressure on inflation to saying we now see a balance of risks. Instead of saying we need to get inflation back into the target band, they've said inflation's comfortably in the target band, where we need to maintain it here now. So there was a bit of conjecture about whether the RBA would continue to play hardball, and indicate that they're reluctantly cutting rates. In the press conference afterwards, they actually said they were thinking about a 50 basis point cut. So it's a complete 180 from Australia. And so that really means that Australia, which was previously the last holdout on inflation, is now looking to cut rates further. But it means that in a bit of a reversal, the Fed now looks like to be the last holdout, because they were happy to cut rates last year, but now looking at the potential inflationary impact of tariffs, they've turned into the holdout. So that's interesting, because really you'd think that would have added some support to the US dollar as well. It hasn't. And again, it just paints a picture of how weak the US dollar currently is.
So the Aussies' reaction, or the Aussies' sort of outlook in the short term, long term, what do you reckon?
Yeah, so that's a great question, because the Aussie US probably has the opportunity to go higher, despite the expectations of further rate cuts, because the US dollar has been weak, and we've seen that in the market. So even after the RBA cut rates, the Aussie dollar was broadly steady, but the Aussie's getting smashed versus other currencies. So you can see the Aussie euro, the Aussie pound, the Aussie kiwi, all sharply lower as well. So it really is two different stories. There's the Australian dollar story and then the US dollar story. But for now, there's still the potential for the Australian dollar to head higher.
Nice one. Great stuff as usual, Steve. Thanks for the insight, and do stay tuned for more podcast updates each week. We'll be on every other week, but don't forget to subscribe to your regular dose of market insights on Convera's blog page. Thanks for listening, and see you next time. Cheers, Steve.
Thank you. Bye-bye.